Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. Joining me today, my good friend and special guest, Dr. Friday with Dr. Friday's tax and financial firm over in Brentwood, Tennessee. She is the tax expert for individuals and small business owners, and I highly recommend her services to you. She's been doing my taxes now for over 20 years. Payroll, does all the business stuff as well as my personal taxes, and again, and probably works with, I don't know, 60 or 70 at least of my clients, I think, in doing their taxes as well. So again, highly recommended. We've been talking about tax deferred sources of retirement income just before the break, and we had the examples of pensions, money in your retirement accounts like 401ks, thrift savings plan, TSP for you federal employees and military out there, traditional IRAs, again, 403B, SEP IRAs, annuities. This is one of those. Now, the money you put in an annuity, assuming it's not an IRA, right? It's just monies you've saved. That's your cost basis, right? That money that goes in, your original investment, you've already paid tax on those monies. So with the annuity, when you start taking money out, you're only going to be paying taxes on the interest earned. Now, their rule is that it's in this situation, it's first in, last out, meaning the money that I invested in and put in there in the first place, right? When I start taking money out, it's the interest that comes out first and is taxable. First. I use up all the interest, or when I've used up all the interest, then it's the principal coming out, and of course I've already paid tax, so that would not be taxable. Now, you can also, with annuities, you can annuitize, and what that means is I'm going to, rather than take just as, take money out of it systematically, let's say, just take withdrawals, which the rule I just mentioned applies. But instead, let's say I want to annuitize it, and I'm going to swap that annuity, and I want to take income for life, let's say. Well, now it's going to, each payment is going to be a combination of principal and interest. So likely about, 40 or 50% of it might be taxable, for instance, or whatever that prorated amount may come out to, depending on how long you've had it, how much interest you've built up in it, that kind of thing. Key is whatever comes out of retirement accounts, pensions, and the exception being Roth, of course, but pensions, retirement accounts like IRAs and 401ks and annuities, that it's taxed at ordinary income tax rates, not at capital gains rates. Now let's look at the next one here, tax-free sources. We like tax-free.
My favorite, yes. Tax-free is pretty good because we talked a little bit about the capital gains, which is one I run into probably most, is when somebody is basically making, a married couple making less than 112 this year, or a single person making, less than 56 or whatever, and that it would include the capital gain itself in all of your earnings. You would be at a 0% capital gains, which, I do feel sometimes people do not look at that when they're doing their investing sometimes. Like you can take out smaller amounts that might keep you in a zero capital gains instead of doing some of it all at one time.
And this is where so certain municipal bonds, for instance, could apply to. Then you have retirement savings. Right,
the Roth being, of course, the number one, right? That's tax-free.
Yeah, so the Roth is the big one. That's this is why we, really like putting money. In rule of thumb, I'll give you a quick, another little tip, because I just had someone in recently. We were talking about the difference between putting the money into a Roth IRA and a traditional IRA. So one quick rule of thumb, if you're in that 10 or 12% bracket, so let's say, again, your income is, for a married couple, your income's under $100,000, I would be putting money into a Roth IRA rather than traditional. If you have a 401k at work, a 401k Roth same thing. I'd want to take advantage of that. Now, there are some,
limitations, right?
This is not this isn't just a one-size-fits-all kind of statement, all right? There are exceptions to this. So an example would be sometimes with Roth, they won't let you do they won't do matching with Roth. So you can have a 401k and you can have the option of the traditional side and the Roth side. If you're getting matching, say you're getting 5% matching, but it has to go in a traditional, do so. Forget about tax bracket, take the free money. That's 5% free. So you want to take that. Now, after you've got your matching, then if you're in that 12%, maybe you switch over and you start putting money into the Roth IRA at that point. If you've got an ability, say you're over 112,000, but you let's say it's 120, and you put $10,000 into your 401k, now you're in the 12 again. Switch over to the Roth. So because 12% tax rates are historically low, and in particular at the 12% tax bracket, and basically in about 5 years, and the last year in fact being 2025 at that 12% bracket. Starting in 2026, the sunset provision is going to push you up to 15, so you're automatically going to have a tax increase coming up, and with the kind of spending and everything, we may see some bigger tax increases down the road as well.
I think I want to jump in and just reiterate that this isn't for everyone, because if you come to my office as a tax person, my job really is to reduce your taxes. So I might say, you know what, for the Roth, it will grow tax-free, but if you contribute $7,000 at 12%, I can save you $1,200, whatever it is, and you know, that's what I'm going to do. It's not, tax people are not advisors for the future. We're looking at this year, this instant in most cases, unless you're working with someone. So a lot of times when you go into a tax office, they may suggest you putting money into an IRA, but it may not be looking at the big picture, I guess I want to say. We're often looking at today, what kind of gratification can you get, right? Yeah. And so, I mean, I'm huge on the Roth. I love the Roth.
And most tax, you know, what Friday's talking about is what most tax people are going to be doing. They're looking at how can I reduce your taxes this year? Here's some things you can do to do that. And with the type of planning I do with financial planning, in particular for retirement, we're looking over your lifetime. Exactly. Right? And potentially, depending on your goals, maybe you've got legacy goals that, yeah, you want to look after the kids and the grandkids, and you've got sufficient resources that there's going to be money there. Then we're looking much longer term in terms of how we're going to minimize taxes, not just this year, but long term. And in particular, if I know that in I've got clients, for instance, that we're doing Roth conversion strategies with, and the reason for it is because their income taxes, if we don't do that, when they hit that RMD age, that required minimum distribution age, is going to go way up. So we do an analysis that shows us over the next, say, 10 years, 20 years, what your taxes are going to be depending on these different strategies, not just in the 1 year. So this is something to consider. Same thing goes with those RMDs that we talked about. So on a tax-free, again, you've got Roth is one of the best ones. When you look at the different ones on this chart, we had certain municipal bonds. We had the retirement savings account, Roth 401k, Roth IRAs. There's a health reimbursement arrangement, or HSA, health savings accounts. These are great, by the way. On health savings accounts, as an example, on HRSA, if you put the money in, you get a tax deduction when you put it in. Right. But it works like a Roth a little bit, meaning that if you use the money for medical expenses when you take it out, then you don't have to pay tax on it. Right. Now, let's say you're over 65, you've retired, you've got a chunk of money you've built up in your HSA, your health savings account, and you take it out, but you don't use it for medical. For medical, now you're going to be, it's going to be taxable. Yeah. Yeah. So this is one non-taxable portion of Social Security income, life insurance, cash value. One of the things when it comes to tax-free, we used to say basically there are three versions. So the HSA, I guess you could say, is a kind of a hybrid fourth. But the three being municipal bonds, cash value life insurance, and of course Roth IRAs. Well, one of the things with municipals, they don't pay a lot of money, right? So you get some tax benefit, but unless you're in the top bracket, I don't know that that's going to be the best way to go. Then when you get to life insurance, cash value life insurance, again, depending on if you're in a higher bracket, this is going to have the most benefit to you as far as how you can take money out and not pay tax on it. It's used by, there are a lot of different strategies that can do that. If you'd like to find out if this would be something that worked for you, just let me know and we can show you that one. Then the thing that the cash value life insurance and Roth have in common is that you can invest them to where you can get more growth than a fixed account. So on the life insurance, though, it also depends on what kind. So there are some kinds of life insurance where it's just a fixed amount, right? Similar to kind of immunity in that sense. It maybe just pay you a little bit of interest. And there are others, though, that can be invested in sub-accounts or in index accounts where it can grow considerably, much like if it was invested in the market, and give you an even bigger tax benefit, tax-free benefit over time. Right. All right. the key here is understanding, right?
There's
Maybe
different
getting a clue
categories.
about some of the things we've talked about. Having more than just one source is the key. If you've got everything just going into a straight up 401k and you've not paid tax on it, that's going to give the least amount of flexibility when taking income, and we're going to have to get even more creative to make sure that we can, within the rules, of course, minimize your taxes as best we can, but it's a little more difficult. If you've got money in a Roth and money in a non-qualified as well, boy, that gives us a lot of ways we can kind of mix things around to get the income you need. You might need $120,000 a year income, for instance, to get that 120, and yet at the same time keep you in a lower bracket, say 12%. Okay, we do that all the time. Right. It's, this is having these different income sources can help do that. All right, let's take a look. Social Security considerations. Oh, we actually have to break.
Okay.
So when we come back, we're going to talk about Social Security benefits, and in particular, this is an area that, a lot of times you may not realize that those benefits are going to be taxed, or likely to be taxed depending on your income. As much as 85% of what you get from Social Security could be counted as taxable income. All right, we're going to explain that and go into it in more depth. But first, a break. Join us here. We'll be right back on the Retirement Report.